for maybe $400, clearly it would not be worth its purchase price. And given the alternative return discount rate of 10%, the investment is worth only only $379. The net present value is the applicable concept here, denoting by the discount rate applicable to the investment. The NPV is calculated as follows. Here, for example, that's the series of 5 cash flow of $100 is shown for 250. Then as shown below, as shown like this table, you can see that the NPV is equal to 129 because the cash flow you on, like I've mentioned, the cash flow you have a check rate the minus of 250. Then the NPV we also take the sum of the sale the sum of the present value from the first year to the fifth, and here we also have the answer. We also use the sum function again, and we will take the sum of present value to calculate the NPV. However, when using the NPV function, we should note that because now we have the negative result in the cash flow, so you should consider a little bit about this one. Here, we should take the minus 250. It means that in the row P, in the column P33, then we will plus with NPV function like we have mentioned on the second table. That's the discount rate is 10%, and then the value of cash flow from the year 1 to the year 5. Yeah, it's the result $129. You should remember that we must take the values of the cash flow minus minus 250. Here is some consideration. And for the next one, we will talk about the present value of an annuity and some useful formula. Here I will show you two screenshots about the formula of PV of finished annuity and PV of unfinished annuity. And for the first one, an annuity is a security which pay a constant sum in each period in the future. An annuity may have a finished or infinite series of payment if the annuity is finished. Here, the appropriate discount rate ER, then the value today of the annuity is present value, like you can see the formula. And whereas if the annuity promises an infinite series of constant future payment, then this formula reduced it to like you can see. And part of this formula can be computed with itself actually. Below we will I will give you some kind of example that compute the value of a finished annuity in 3 ways, using the formula, using the Excel PV function, and using the NPV function. Here for the first one, talk about the finished annuity. I give that the periodic payment is C, and this value is $1,000. The number of future periods paid is N, is 5 years. The discount rate ER and equal to 12%. And to calculate the present value of annuity, we have 2 ways. The first one, we will use the formula here. The formula like you can see on the screenshot to calculate the present value. And here I also check for you that I will ignore about the formula using the way that's use the formula because it's based it's kind it's a kind of handwritten exercise. So now I just show you the way to use Excel to calculate the present value. So when we use Excel PV function, we will show you the PV function, and here we will put the rate of 12%, and then the number of future periods paid is 5, and the payment right now is the periodic payment, and you should remember that we also take minus 100, a negative result of period payment. Yeah, we will have the result that $3,604. To calculate the NBVs when the annuity payment have a show, the period is 5 years, and the annuity payments is equal to in every respective year is equal to $1,000, and at that time we will have the NBV, like we will have a calculate on of the upper table. We also have the NBV function. We will take the discount rate ER 12%, and then we will take the sum value of annuity payment from year 1 to year 5. We also have the result that the NBV, the net present value also equal to the 3,604. For the next one, the next concept is about the present value of infinite annuity. And actually, I think that it would be the most easiest when you use the formula instead of the Excel function. So I just showed you the way to calculate present value of annuity when you use the formula. It's more easier than use the Excel function. So keep everything unchanged. See also the periodic payment also equal to 1,000. The discount rate is also 12%. So then the present value of annuity will equal to we will take C divided by R. It means that 1,000 divided by 12%.
So what you call an infinite annuity in corporate finance? You will learn this term.
Sorry, can you repeat again, because some of noise.
Okay, what you call an infinite annuity? Because in corporate finance, you study this term.
What will we call the infinite annuity in corporate finance?
Yes. Do you remember?
Sorry, but actually I don't remember what it will call in corporate finance.
Is it perpetuity? Perpetuity. Remember that?
Okay. Yes, perpetuity.
Yes.
And for the next one, we will focus on the value of a growing annuity. It also have two famous formula, like you can see on the screenshot. The first one is the present value for finished growing annuity, and the second is the present value for infinite growing annuity. And a growing annuities pay out a sum of C, which growth does a periodic growth rate is G. If the annuity is finished, its value today is given by this formula. And taking this formula and letting and come to the positive infinitively, we can compute the value of infinite growing annuity like this formula. And this formula can easily also be easily implemented in Excel. And below, We compute the value of a finished growing annuity using the formula above and using Excel NPV function. For the first one, I will calculate the value of finished growing annuity. The first payment is $1,000. The growth rate of payments each year is 6%. The number of future periods past EN and 5 years. The discount rate are and 12%. And now we calculate the present value of annuity by using the formula. Well, equal to the formula I mentioned above. And next, to calculate it by using the NPV function, you should first one you should calculate the annuity payment first. Then you will apply it into the NPV function to calculate. And for the first year, this annuity payment is equal to the first payment actually. And for the second years, this annuity payments will equal to 1,060. Like you can see the formula. I will take the first payment multiply with 1 plus the growth rate of payment, and then with the parallel of the years. I means that take the next year minus with the first one, and you should remember that fit the first payment and the growth rate of payments by effort. Here I have a calculate for the result, and to calculate the NPV function, you should also take the NPV function with the rate of 12% and the sum of annuity payment from the year 1 to the year 5 to get the answer. Is $4,010 of the NPV of the value of next present value function. And to the next concept is about the BV under the present value of infinite growing annuity. And actually, it's also easier for you to calculate by formula than using Excel function. So I just show the way to calculate it by the formula. Keep everything unchanged. Here the BV annuity will equal to, we will take the value of periodic payment is C is 1,000, and then you divide it with the discount rate minus with the growth rate of payment each year to get the answer, like you can see. And here we should I also I read some material and get some standard formula. It's also a famous formula for you to apply in this chapter, the golden formula. The golden formula actually, as far as I'm concerned, the golden formula's value stock by discounting this value by discounting its future anticipated dividend at the cost of equity RE, and letting P0 P the current stock price, and D and the D0 is the dividend, the current dividend, and the G is the growth rate of future dividend. And then we will have the formula. And actually, this golden formula is most used in financial modeling in chapter 4 and 5. And next, Phương Trâm and Phương Như will have you to have a good viewing about this formula. And keep going. We will come to the next part with the concept of the internal rate of return and the long table. We will use the internal rate of return in the long table. So the internal rate of return is IRR, as you can see, is defined as the comparative rate of return R, which make the NPV equal to 0. And to illustrate, consider the example given below. approaches cutting 800 in year zero return a variable series of cash flow at the end of year from 1 to 5. The internal rate of return of approaches is calculated equal to 22%. We also, it's really simple for you. We just also use the internal rate of return function on Excel. Everything have a set up and you just put all the values into it. Here, the internal rate of returns will equal to all of the value from the first to the last. Yeah, like you can see, the internal rate of return will equal to 22%, nearly 22%, but it actually maybe that's 22.16%. But here, you have a note that the Excel internal rate of return function include as argument all of the cash flow of the investment. So that's the reason why we also take the value of 800 when calculating the internal rate of return. And the question here is how to determine the internal rate of return by trial and error. There are no simple formula to compute the internal rate of return. Actually, Excel internal rate of return function use trial and error, which can be simulated by using trial and error in a spreadsheet, as illustrated below. The internal rate of return. Here, we have the discount rate is 12%, and the cash flow right now is not constant. It changes year by year. And we also can calculate the net present value. It's a really familiar with the Apple concept that we also take the 800 with a minus, and then we plus with the NBV function with the discount rate itself and the sum of the rest of cash flow if from year 1 to year 5. You must remember that we also take the value of this you calculate. And here we will come to know about a really new concept that we will use the goal seek to find discount rate that make the NBV equal to 0. And when the NBV is equal to 0, what is the discount rate? What is the value of discount rate? We actually will use the goal seek to find it. Like you can see, and I will take you. So when where is the goal seek? The goal seek is on the data post in the what if analysis. We will use the goal seek like we will fix the value of NBV to the value 0, and by changing the discount rate also fixed. At that time, here you can see when the and to have the result of net present value equal to 0, you should have the discount rate of 22%. Like you can see. And this is the way that the goal shift tool actually active. And to the next one, I will talk about the loan table and the internal rate of return. It's really, I think that is really familiar with you because you have learned it in the course of commercial bank in the last semester. And the internal rate of return is the compound rate of return based by the investment. Actually, to understand this fully, the loan table have you to make you have the obvious understanding, which show the division of the investment cash flow between investment income and the return of the investment principal. Like you have a study in the cost commercial bank. When using the internal rate return in loan table, uh, for the investment at the beginning of year, you will calculate right. Really familiar with the commercial bank. The income right now will be equal to, you will take the internal rate return multiply with the investment to have the income. And then we will calculate the return of principal by take the value of the cash flow minus with the income to have the return, to have the value of return of principal. Here I have a note for you to have the best view. And we just calculate step by step to until the last, until the investment of the at the beginning year is zero. It's when it's equal to zero, it's indicated that on the principal has been rebate. And come to a really important concept that use the loan table to find the internal rate return. Actually, we also have a 6 year, and the principal at beginning of year is equal to 1,000, and we calculate the cash flow. The cash flow is given actually, and the income. The income right now is equal to the you will fix the internal rate return, and then you multiply it with the value of the principal to have the income. You just do it step by step to get the answer until the last, and then we will use we also use the goal sheet to find the IRR, the internal rate return. The set cell we will equal to the principal, the last principal to the value 0, and by changing cell the internal rate return. So to have the value, to have the 0 value of the principal, you have change your internal rate return at 24%. This is the way to calculate the internal rate return when using the loan table. And next is about the Excel rate function. Excel rate function compute the internal rate return of a series of a constant future payment. In the example below, we will pay $1,000 today for annual payment of 100 for the next 30 years, and ratio that the internal rate return will equal to 9% due to the rate function. We will take the number of payment, the 30 year, and then the period is 100, and next is the initial investment, and you should remember that the initial investment it bring the negative value. It means that minus 1,000. We have the result of internal return is 9%. And we will move to the next part, the multiple internal rate of return. Sometimes a series of cash flow have a more one internal rate of return, like you can see above. And now we will have an overview about the multiple rate return. It means that have a more than one internal rate of return. In the next example, I can tell that the cash flow from the column C 185 to 190 have a two internal rate of return because the net present value graph cross the x-axis high. Here, I will do it for you to understand. For the first one, it's really familiar with like we have mentioned. We just calculate the internal return. However, in that part, actually we will have a two internal rate of return. So what's it new here? And here I also prepare for you a long table, a data table for you to have a more understanding. To the NBV, the net present value, is equal to the net present value like in this table. And for the net present value, I will take it right. Wait a minute. I will fix the first cash flow by F4, and then I plus with the NBV function is the sum value of the cash flow from U1 to U5. Sorry, I forgot to fix the net present value. You have to fix the net the value of cash flow to have the result when use the net present value function on Excel. Here, I have a calculate the value of net present value related to each discount rate. And then I will take it into a data table, and BV will show by the next part chart.
So how to use the data table in this situation?
We will use it to imply that we will have a two net present value. We will use the graph to imply that we have a two net present value because the graph cross the x-axis two times.
I know that, but I want you to show how to use the data table here.
It means that how to calculate the data table.
Yes, how to calculate the data table.
Yes.
You can explain more for us to understand how the data table work here.
Yes. The data. Our group have discussed about the data table, and actually this data table is you can see it's more about in the chapter 31, but here I use the data table for you to have the graph. And as far as I'm concerned, the data table here I will use the two value, that's the discount rate and the NBV function and the net present value to create a data table. Assume that the discount rate is from 0% to the 39%, and it's respective to the net present value. We can calculate the net present value by taking the NPV
Yes.
function.
Yes, I know that. We study two skills here using the GONSIC and the data table, and I know how. I want to know how to use the data table. You can delete the NPV columns, the value of NPV, and you do it again first to know how to use the data table. Because the data table is very popular and is very useful in many kind of situation.
Thầy
You
ơi,
have to learn how to use the data table.
thầy mạng bên hình như giọng thầy nó hơi ngắt quãng, thầy không nghe rõ thầy nói gì hết. Thầy có thể nói lại được không thầy?
Em chỉ cho lớp biết cái cách sử dụng data table ở đây đi.
Là cái cách em làm.
Cái cách làm á. Đúng rồi. Cái cách làm á. Em xóa cái cột MPV rồi em thực hiện lại cái data table. Tại vì data table nó rất là hữu dụng.
Dạ
Trong rất nhiều trường hợp mình không thể tính tay mà mình dùng data table.
Dạ em hiểu rồi thầy.
Ok.
I will calculate the NPV. However, we will check the first NPV is equal to nearly -4 here. It means that equal to the value of net present value. And then to calculate all of this, you should use the function like you will fix the first cash flow by F4, and then you multiply, and then you will plus with the NBV function. Here we will have I will have the rate of 6%, and then we take the sum of the rest cash flow from the year 1 to the year 5. And you should remember that fix this value by F4 too.
No, the data table doesn't work like that. You know, in the data tab and the what if analysis, you have two useful tools to analyze any information as a GONSIC and the data table. So if you want to use the data table, you will choose on the block, including the discount rate and MPV, 2 columns. You choose on the block. Okay. You don't need to calculate every line in the data table, because the data table work as you just use the original information, and it will replace the discount rate into your formula and will calculate all the NPVs for you. So follow my instruction. You
Okay, I got it. Yeah, sorry, I have some mistake. I placed with the rate. Like this, and then for on the rest.
no. Data table doesn't work like that. Okay, I show you the how data table work.
Yes, I will stop sharing.
Just wait. Hold a second. I will open the file. Sorry, I have a problem with my computer. Can you open? Can you share your screen again with the file? I will show you
Yes.
how to do that.
Yeah.
So in the first line of MPV, you just the above line, the -3.9. Yes, you just type the cell D1F3, okay, and you just clear on the value of MPV. Yes, okay. So you choose the two columns from the first line, the discoverage and the MPV from the first line, the line above.
Yes.
No, you choose on the block.
Of discovery and MPV.
You choose on the block. Em đánh dấu khối hết á. Đúng rồi, hai cái cột đó luôn. Từ cái hàng đầu á, đúng rồi. Ok, rồi. Rồi em chọn what if analysis. Thì chọn data table. Rồi, trong cái data table này á, cái row và cái column á, nó có nghĩa gì? Nó cho em nhập hai chiều không gian vào. Cái column ở đây á, là cái column là cái cột đầu tiên của mình, đó là cột tham chiếu á. Nó sẽ giúp cho chúng ta lấy cái giá trị từ cái ô nào đó, từ cái cột này nè, thay vô cái ô đó và tính ra cái MPV trả về cái cột thứ hai là MPV. Vậy thì em chọn ở đây là mình theo cái cột, cho nên mình sẽ chọn column. Cái hàng này mình không có, mình theo cái cột, nó sẽ giúp cho mình có hai chiều luôn, nhưng mà mình dùng ở đây mình dùng một chiều thôi. Mình vô cái phần column đó, vô cái ở dưới đó. Đúng rồi, mình chọn vô cái ô NPV trừ 3.99, không, bên đây nè, cái bên ô NPV bên đây nè, bên cái ô công thức. Để chi biết không? Để nó lấy từng cái giá trị trong cái cột discovery này, thế vào cái ô này, sau đó thì nó sẽ tính ra cái NPV và nó trả cái cột NPV cho mình. Đó. Thì cái data table nó rất hữu dụng khi mà em giả sử như thay vì em phải tính toán từng cái, em cứ tưởng tượng đi, nếu mà em có một cái công thức từ đầu cho tới cuối nó rất là phức tạp, thì em sẽ thấy nó qua cả hàng trăm công thức luôn, và em không thể nào viết cái công thức đây em kéo xuống được. Cái này nó dễ, em kéo xuống thì được, còn nếu mà nó khó, nó phức tạp quá, qua rất là nhiều hàm mà em đâu kéo được đâu. Thì cái NPV, cái data table nó giúp cho chúng ta là thế từng cái giá trị mà chúng ta muốn tính vào, và nó sẽ trả về cái kết quả cuối cùng, nó nhét vô lại cái bảng của chúng ta. Đó. Bây giờ chúng ta enter thôi.
Yeah.
Rồi chúng ta ok.
Nó bị lỗi.
Em chỉ cần em xóa lại đi, em xóa lại. Tại vì đánh dấu từ cái ô đầu tiên đó, cái trên luôn. Rồi em làm lại nè, em xóa hết cái cột đi. Xóa hết luôn cái cột NPV.
Yeah. Máy em nó bị từ từ, máy em nó bị lỗi.
Em phải xóa luôn nguyên cái từ cái bắt đầu nãy em chọn data table.
Dạ, để em mở lại file, tại vì cái máy em làm tới đó cái file này bị lỗi.
Ok. Thì cái kỹ thuật sử dụng data table này các bạn có thể đọc thêm ở trong phụ lục của sách đó. Nó có một cái phần mà tăng cường cái kỹ thuật sử dụng Excel á. Các bạn đọc thêm về cái data table thực ra đơn giản lắm. Qua cái ví dụ này thì các bạn sẽ thấy là chúng ta sử dụng data table trong rất nhiều trường hợp. Ở đây thì chúng ta chỉ dùng một cái chiều thôi, nhưng mà data table nó cho chúng ta hai chiều, là vừa cái column và vừa cái row. Thì các bạn nghĩ nếu mà giả sử như các bạn muốn tính hai cái giá trị input, vừa là một cái row và một cái column, thì hai cái input đó để ra một cái output đó, và các bạn muốn thế nhiều giá trị vào hai cái input đó, thế nhiều cái trường hợp vào hai input đó để ra cái output, thì chúng ta sẽ dùng cái data table cho cả cái row và cái column luôn. Các bạn thấy là cái data table này á, chúng ta thường sử dụng trong cái trường hợp nào? Scenario analysis tức là phân tích tình huống, đúng không? Phân tích tình huống là mỗi một cái tình huống, trong cái bài đầu tiên này có nói các bạn, mỗi một cái tình huống chúng ta có một cái input, một cái nhập lượng, thì cái đầu ra của chúng ta nó sẽ như thế nào? Và giả sử như ở cái data table nó hỗ trợ chúng ta là hai cái nhập lượng là vừa hàng vừa dọc. Rồi bây giờ em làm lại chỗ này. Bây giờ em xóa hết cái NPV từ 0 cho tới xuống dưới. Rồi cái dòng đầu tiên thì em lấy, nó có hướng dẫn em lấy người đêm 1/3. Chúng ta lấy cái giá trị NPV
Thầy ơi, nó bị gì nữa thầy, em không nghe thầy nói gì hết.
Alo, em có nghe không?
Dạ bây giờ nghe thầy.
Ok, chắc là do đường truyền mạng nó yếu. Rồi em enter.
Dạ.
Rồi em đánh dấu khối từ cái đúng rồi, không từ cái đó, từ cái dưới nữa, từ cái dưới thôi. Ok là được rồi. Từ cái dòng đầu tiên mà em đã nhập cái công thức đó vô, rồi em chọn what if analysis.
Dạ.
Chọn data table. Rồi như thầy nói nãy, ở đây ấy, trong trường hợp này chúng ta chỉ dùng một chiều thôi, và cái chiều chúng ta là cái cột, cái columns, cái column của chúng ta, và chúng ta muốn là cái giá trị trong cái column này á, được thế vào cái ô discount rate, để từ đó nó tính ra cái ô NPV, cái ô mục tiêu của chúng ta. Rồi thì trong cái dưới cái column input cell á, chúng ta chọn cái ô discount rate, chọn cái ô discount rate bên đây nè, ô discount rate thì bên đó. Rồi chúng ta enter, rồi chúng ta nhấn OK. Đó. Thì nguyên tắc nó nãy như thầy nói rồi, nó sẽ thế từng cái trong cái cột discount rate của chúng ta, nó thế từng cái giá trị đó vào cái ô discount rate này, và khi mà thế vào như vậy thì cái công thức nó sẽ tính ra cái NPV mới, và nó trả về cái NPV mới vào trong cái cột thứ hai, cái cột NPV thứ hai đó. Thì cái tình huống này các bạn nãy các bạn làm theo cái kiểu mà kéo xuống á, thì nó cũng ok, tại vì công thức nó quá đơn giản. Cái công thức của chúng ta nó chỉ là NPV tính cho cái bảng 5 dòng tiền này rất là đơn giản. Nhưng mà các bạn, ví dụ các bạn ở một cái tình huống nó phức tạp, một cái bài toán nó trải qua hàng trăm cái công thức, mà bây giờ chúng ta muốn phân tích tình huống, tức là chúng ta xem cái input đầu vào chúng ta thay đổi, thì cái output của chúng ta nhận được những giá trị nào. Chúng ta không thể nào mà chúng ta cứ giả sử như chúng ta muốn phân tích cả trăm tình huống đi, thì không thể nào chúng ta cứ ngồi chúng ta thế vào chúng ta nhấp vào, chúng ta ra một con số của chúng ta copy được. Mà chúng ta áp dụng cái data table này, nó sẽ rất là hữu dụng, cực kỳ hữu dụng luôn. Và nhớ là data table nó cho chúng ta hai chiều, ở đây chúng ta sử dụng mới có một chiều thôi, nếu mà giả sử như chúng ta ở trong cái tình huống này thì nó quá đơn giản, nó phụ thuộc vào chỉ có cái discount rate. Giả sử như chúng ta có thêm một chiều nữa là cái dòng tiền năm thứ nhất á, chúng ta có nhiều trường hợp đó, thì chúng ta có thể tạo thêm cái data table, thêm cái row nữa, và cái row đó chính là cái dòng tiền năm thứ nhất và những trường hợp của dòng tiền năm thứ nhất. Thì ở trong từng cái ô nó sẽ là đối chiếu của từng trường hợp, là discount rate bằng 3% với cái cash flow năm thứ nhất bằng 200 đô chẳng hạn đó, thì nó sẽ tính ra. Và lúc đó chúng ta sẽ dùng cả hai chiều của cái kỹ thuật data table này. Rồi, ok. Rồi chắc là ở đây cái nội dung ở đây là cũng ok rồi. Cái phần còn lại khỏi trình bày. Chúng ta tập trung qua cái nội dung của cái chương 2. Như lúc đầu thầy nói là chúng ta focus vào cái nội dung corporate valuation với lại calculate WACC nhiều hơn ha. Rồi các bạn qua đây đi.
Hello teacher, I'm new and now I will present the part 2 corporate valuation overview.
Okay.
And first is what is corporate valuation about? When we discuss the valuation of a company, we may be referring to any of the following. Firstly is the enterprise value. It is to value the company's productive activities, and enterprise value is a measure of a company's total value, often used as a more comprehensive alternative to equity market capitalization. And EV includes in its calculation the market capitalization of the company, but also short-term and long-term debt, as well as cash on the company's balance sheet. Enterprise value is a popular metric used to value a company for a potential takeover. And second is equity. It is to value the shares of the company, whether for the purpose of buying or selling a single share, or valuing all the equity for purpose of corporate acquisition. Next one is debt. Valuing the company's debt. When debt is risky, its value depends on the value of the company that has issued the debt. And I would like to mention other factors because we may want to value other securities related to the company. For example, the firm's warrant or options, employee stock options. And in this chapter, there are 4 methods to compute enterprise value. The key concept in corporate valuation is enterprise value, and the EV of the firm is the value of the firm's core business activities, and it forms the basis of most corporate valuation models. We distinguish between 4 approaches to compute enterprise value. The first is the accounting approach to enterprise valuation. In this accounting approach, the accounting approach to enterprise valuation moves items on the balance sheet so that all operating items are on the left-hand side of the balance sheet and all financial items will be on the right-hand side. Although most academics near at this approach, it is often a useful starting point for thinking about enterprise value. The next one is the efficient market approach to EV revalues. To the extent possible, items on the accounting EV balance sheet at market values. An obvious revaluation is to replace the firm's book value of equity with the market value of the equity, to the extent that we know the market value of the other firm liabilities, debt, pension obligation. This market value will also replace the book values. And the last one is the discounted cash flow, DCF approach values the EV as the present value of the firm's future anticipated free cash flow, discounted at the weighted average cost of capital, WACC. The FCF can best be thought of as the cash flow produced by the firm's productive assets, its working capital, fixed assets, and goodwill. And in this method, it is divided into two types and will be mentioned in chapter 4, chapter 5, and 6. In chapter 4, we base our projection of future anticipated on an analysis of the firm's consolidated statement of cash flows. And in chapter 5 and 6, we base our projection of future anticipated on a pro forma model for the firm's financial statements. And come to the using accounting book value to value a company. So, I mean that we rarely use accounting number to value a company. So the balance sheet of a company is a useful starting framework for the valuation process. In this session, we show how accounting statements can help us define the concept of the enterprise value. And as a starting, we will consider balance sheet for XYZ Corporation. So this is the balance sheet for XYZ Corporation. And next, we will apply the accounting book value method to rearrange and value this corporation. So we will separate the operational versus financial item in short-term assets and short-term liabilities. And next, we move the operational current asset to the left side of the balance sheet, and we move on the debt into one debt item. So to calculate the firm's net financial debt, we deduct liquid assets, include cash and marketable securities from financial debt. When we're done with this stage, this balance sheet will have all the firm's producing assets on the left side and all of its financing on the right. The firm enterprise value defined as the worth of the firm's operational assets will appear on the left-hand side of the resulting balance sheet. And these are the assets that provide cash flow for the company actual operation. And this is the example of the balance sheet for Caterpillar Corporation. And to get to the enterprise value balance sheet for Caterpillar, we will move financial item from the left side of the balance sheet to the right, and we move the operating current liabilities from the right side of the balance sheet to the left. And we net our liquid asset. The assumption of these assets are not needed for the core business activity of the Caterpillar. So the book value of Caterpillar enterprise value is $59,476,000. So we'll move to the next part is the efficient market approach to corporate valuation. So the Caterpillar example move assume that the book value is a correct valuation of the company, but a single calculation shows how problematic this is. At the end of 2011, Caterpillar has 624.6 22 million shares outstanding, and the market price per share was $90.16. This suggested that the Caterpillar's enterprise value is $102.720 billion, and it is a far cry from a book value of the enterprise value of $95.476 billion. And the efficient market approach to the valuation of Caterpillar equity and financial liability assume the market value of company's share or debt is simply the market value of the time valuation. So when the efficient market approach is applied to the Caterpillar enterprise value balance sheet, the right-hand side of the enterprise value comes out to 105,719,878 dollars. Of course, the necessitate revaluation of the balance sheet left side assume that the net working capital value is a reasonable approximation to its market value to bring this enterprise value balance sheet into balance. To balance the balance sheet, we might recalculate the market value of the firm long-term asset.
So what is the drawback of the efficient market approach? What's problem with the
Sorry, teacher, can you ask again?
I mean, what problem when you use this approach?
Yeah, I think teacher, can you please wait me a minute?
Okay. So we can see the first way to evaluate the corporation is using the accounting value of the balance sheet of the company, and this is the second way, use the market value. So what the problem with the market value?
Yeah, I think the difficulty in determining market value lies in estimating the value of illiquid assets like real estate and businesses, which may necessitate the use of real estate appraisals and business valuation expert respectively.
Yes, it's a one of our problem when we use the market value. We have to know the market value of on the assets, and especially we have to know the market value of liabilities. You know, the market value of equity is a simple, is very easy to get the market value of the equity because you just take the market cap, you take the outstanding share, multiply with the price per share, and you get the market cap. But how about the liability? How you can evaluate the market value of the liabilities is very difficult. Okay, so in this situation, we can see the owners use just the book value of liabilities and the book value of all the assets, and he's balanced with those items to take the result. And I think maybe it's not relevant in some situation. So remember, when you want to evaluate the corporation and you want to take the market value of the corporation, the market value of corporation equal to the market value of equity plus the market value of the liabilities. So you can get the market value of equity, but you don't take the market value of the liability. It's a very difficult. One way to overcome this problem is to use the Merton framework, the option, the Black and Scholes framework, to calculate the total value of the corporation, total value of the enterprise, and use simulation to calculate the value, the market value of liabilities. And this is a very difficult way, so we can study more in the future. Okay. Keep on.
Yes. And the next one is enterprise value EV as a percent value of the free cash flows. The DCF top-down valuation approach. So in the previous session, we valued the EV by using the market value of the right-hand side of the firm's enterprise value balance sheet and using the market value of its equity and the market valuation of other elements of the firm's financing. So in this session, we will concentrate on the left-hand side of the enterprise value balance sheet. The discounted cash flow method focuses on two central concepts. The first is the firm's free cash flow, or defined as the cash created by the firm's operating activities. Secondly, the firm's weighted average cost of the capital. WACC is the risk-adjusted discount rate appropriate to the risk of the FCF. And the firm's enterprise value EV is the present value of the future FCF discounted at the WACC, and we'll using this method, which I capture from the screen. So the idea to value a company by considering the present value of the FCF, where future cash flow is defined as a cash flow to the firm from its asset and can be fixed asset, intellectual and trademark asset, and net working capital. The next subsection discusses this concept in more detail. So here, I will define the free cash flow. Free cash flow presents the cash a company generates after accounting for cash outflows to support operation and maintain its capital assets. And unlike earnings or net income, the free cash flow is a measure of profitability that excludes the non-cash expenses of the income statement and includes spending on equipment and assets, as well as changes in working capital from the balance sheet. And free cash flow presents the cash available from the company to repay creditor or pay dividends and interest to investor. Next is free cash flow reconciles net income by adjusting for non-cash expenses, changes in working capital and capital expenditures, which is CapEx, and finally, however, as a supplemental tool for analysis, free cash flow can reveal problems in the fundamentals before they arise on the income statement. So, free cash flow will based on the income statement. Firstly, is profit after taxes. This is the basic measure of the profitability of the business. But it is an accounting measure that includes financial flows as well as non-cash expenses such as depreciation. And profit after tax does not account for either change in the firm working capital or purchases of new fixed assets, and both which can be important cash drains on the firm. Next is plus with the depreciation and other non-cash expenses. The depreciation is the non-cash expense that is in the free cash flow calculation is added back to the profit after tax to the extent that there are other non-cash expenses in the firm's income statement. They are also added back. And next is we will subtract increase in operating current assets. So when the firm's sales increase, more investment is needed in inventories, accounts receivable. This increase in current assets is not an expense for tax purpose, but it is a cash drain on the company. When we adjust the free cash flow for current assets, we may take care to not include financial current assets that are not directly related to sales, such as cash and marketable securities. And we will plus with the increase in operating current liabilities. An increase in the sales often causes an increase in financing related to the sales, such as account payable or tax payable. This increase in current liabilities when related to sales provides cash to the firm. Since it is directly related to sales, we will include this cash in the free cash flow calculation. When adjusting the free cash flow for current liabilities, we have to take care to not include financial current liabilities that are not directly related to the sales. And then we subtract increase in fixed asset across the CapEx. This increase in fixed asset or long-term productive asset of the company is a use of cash and which reduce the firm's free cash flow. And finally, we will plus with after-tax interest payment. Free cash flow is an attempt to measure the cash produced by the business activities of the firm. So to neutralize the effect of interest payments on the firm's profit, we firstly add back the after-tax cost of interest on debt. Of course, after-tax interest payment or tax deductible. And second, we subtract out the after-tax interest payment on the cash and marketable securities.
So I have a question
yes.
here. Why we need to neutralize the effect of interest payment on the firm profit? As you say, we need to on the firm profit, and why we need to do that?
Yeah.
This is the knowledge in which you study in corporate finance, the advanced corporate finance course. And we need to eliminate the interest payment in the cash flow. Why we do that? So when the company get a profit, they need to pay on the interest payment, and the net profit, the net income, doesn't include the after-tax interest payment. And now we calculate the free cash flow, we need to add back the after-tax interest payment. So you say to neutralize the effect of the interest payment?
Yes.
Why? Because when we use the WACC to discount our free cash flow, the WACC included the financial cost. So we don't need to eliminate it. We don't need to get the interest payment out from our cash flow. We just keep the after-tax interest payment in our cash flow. Okay.
Yes.
Okay, continue.
And this is the end of my presentation, and the next part will be presented by Lê Huy. Thank you.
Okay.
Okay. Can you see my screen?
Yeah, I can see your screen.
Ok,
Okay, hello everyone. In my part is about the cost of capital in entrepreneurships, and in my part we have three part: definition, cost of capital, and WACC. Firstly, we talk about the definition. From the business side, the part of income or practice that the business must pay to the provider of capital in a certain period of time is called the cost of capital. But in the investor side, the company cost of capital is the rate of return that investor require when providing capital to the business. And we have 5 characteristics, which is based on the market requirements, reflecting the return of investor at the present time. Third is about reflecting the nominal interest rate demanded by investor with the amount of capital they invest in the business, consider on the basis of the level of risk. And finally, it's about the usually reflected in percentage. And if we want to calculate WACC, we must to know 4 types of capital, which is total capital, reference shares, retained earnings, and equity capital. First, we will talk about the cost of debt after tax return. It is a total capital, and we have the formula is that RD equal RDT plus 1 minus T, which is RDT is the retained cost of borrowing capital, and RDE after tax cost of this, and T is the tax rate. And in this part we have a trap here because when we calculate the WACC, we need to have the RD, but when sometimes we have like a mistake that for example, if the question is that they give you a retax cost of borrowing capital, we will plus 1 minus T. However, if the question gives you the after tax, you don't need to plus 1 minus T. So I hope that you can notice that that problem. And the meaning of the cost of debt is that RD show how much the enterprise will have to spend to use 100 Vietnam dong of loan after tax, and it is also the minimum rate of return that investor require when allowing business to use after tax loan for 1 year. And in this part, we have one thing to tell with you is that if RD minus RDT plus 1 minus T, they will call it a tax shield. Tax shield is an allowable deduction from taxable income, or we can call it EBT. And the method of that is capital structure optimization and accelerated depreciation method. And I have an example for you. I hope that you can use the calculator to find the result with me. The example is that company A borrows money from a bank at the interest rate of 60% a year.
Sorry, I can see your slide.
Wait a minute. Now you can see my example.
Yes.
Okay.
Sorry, I will turn back a little bit about the cost of debt after tax return for my problem about my laptop. Okay, I will talk a little bit about again That's the cost of that is RD equal RDT plus 1 minus T. And I have told that if RD minus the after that, we will call it a tax shield. And tax shield is an allowable deduction from taxable income, or we call that EBT. And the meaning of the cost of debt is that if we spend 100 Vietnam đồng of loan after tax, RD is also the minimum rate of return that investor require when allowing businesses to use after tax loan for 1 year. And this is an example for this part. So I hope you guys can calculate it with me. So I will wait a little second for you. If you want to participate, just write the result to the chat box. I will see it. So I hope that you can give me the answer of the example. Seven, 8. Okay, thank you, everyone. You have is correct. Thank you so much. Based on the formula, we can calculate RD equal 10 and 8%. And the meaning of the 10 and 8% is that if we want to use 100 Vietnam đồng up after tax loan in a year, the company A will have to spend 10.8 Vietnam đồng in expenses, and 10.8% is also the minimum rate of return that the bank require when letting company A use after tax in 1 year. Next is about the reference shares. The reference shares is the cost of using is understood at the minimum rate of return to be achieved when raising capital equal to its preferred share for investment, so that earning per share or share price do not decline. And in this part, we have 3 formula. With ARP is the reference share, DB is the dividend per preferred share, PPE issuing price preferred share, and E issuing expense ratio based on the issue price, and PNB is a net profit, and big E is insurance cost per preferred share. And the meaning is quite similar with the cost of debt. It shows that have to use 100 Vietnam đồng of preferred share capital in a year, and RP is also the minimum rate of return when to use preferred equity in a year. And this is the example. I hope you guys can calculate with me one more time. Thank you. And now I will show the answer. As you can see that dB is equal D0 plus 50%, so that the result is 1,500 Vietnam đồng per share. And RP, we will use the formula and we will calculate that the cost of reverse share will be 3.75% a year, and the meaning just like the cost of debt, 3.75% is the minimum rate of return that investor require when allowing company A to use reverse share for 1 year. Next is about the retained earning. As you study that the retained earning is the shareholder required rate of return on the company common stock, and it determines the cost of using based on the dividend growth model, and which is P0 is value of common stock, D1 is dividend expected to be distributed in period 1, and R is the investor required rate of return. And the meaning is that it will spend to use 100 Vietnam đồng of retained earning. RE is also the minimum rate of return that investor require in a year. And in addition, RE is also used at the discount rate to calculate the present value of cash flow in the evaluation and selection of investment projects according to the EBB owner method. Next is about the example of this part, and this is the formula. The question is that the pay value of share is 10,000 Vietnam đồng per share. The share price is 50,000, and the current dividend payout ratio is 15%, and the growth rate is 8.5% a year. So we use the formula is that RE equal D1 divided by B0 plus G. So we can calculate the RE as you can see on my slide. And in this part, because we have the growth rate, so D1 we must have to multiply 1 plus 8.5% for the D1, and the meaning is also the similar of the reverse part, so I will skip it. And in the retained earnings, we have the capital asset pricing model, and the formula is RE equal RF plus beta plus RM minus RF, with RE is the investor required rate of return, RS is the risk-free rate, RM is the expected rate of return of the market, and beta is risk coefficient of the stock. And the method of this is that the bondholder are exposed to less risk than shareholder, so the required rate of return for shareholder can be determined by taking the bond interest rate of the company plus the risk premium. And as you can see that in the red line, the cost of retained earnings equal upon year to maturity plus additional risk premium. Next we will talk about the equity capital, and we have two formula in this part. P0 is issuing price per new common share, E is a ratio of issuance, PN is the net price, and as you can see that PN equal B0 plus 1 minus E, and RE is the cost of using newly issued common share, and G is the dividend growth rate. And this is the example of this part. So I will wait a minute to wait your answer before I show my answer on the slide.
What do you call up this approach? This
Yes.
formula? What do you call up this approach? This formula?
The equity capital.
The what?
The equity capital.
Equity capital.
Cổ phiếu
But
thường.
I wonder, what is the formula? What we call this formula? This is the Gordon formula.
Sorry, I don't understand your question.
So, is this the Gordon formula, the Gordon model?
Yes.
What is the original of the Gordon model? And why we can calculate the cost of equity using the Gordon model? So I wonder where this formula come from? And you just show the formula, and you don't show us why we can use this formula to calculate the cost of equity.
Because we spy on the visual current stock price, and from this we have as formula from the with the formula. The formal formula is that P0 equal D0 plus 1 D0 multiplied by 1 plus G and divided by RG minus G. So from this formula, I can calculate the inverting the RE.
There are two ways to calculate the cost of equity, using the CAPM or using the Gordon model. So this is the Gordon model. The Gordon model, you calculate the price of equity, the stock price, use the dividend and the growth and the required return. So you extract the required return in this formula, and you can calculate the required return from the dividend, the stock price, and the growth rate. Okay.
Yes.
It's a symbol, but I don't understand here that somehow you don't follow our content in the chapter 3, and maybe I think you use the own knowledge in the corporate finance.
Yes.
You have a study.
Yes. Actually, when I read the material, I think that I want to find a simple way to illustrate from my friend, and when I read the material, I think that the formula is the same, so I use that rather than to focus too much to the material.
Okay, so keep on.
Yeah, thank you. So from the example, okay, I will show the answer. Because the pay value is 10,000 Vietnam đồng per share, so you can calculate it from like the example is 10,000 multiply 50% and multiply 1.85 to have D1 and PN is 45,000 Vietnam đồng per share. And we have the result is 10.10%. And the meaning is also the similar in the reverse part. Next, I will talk about the WACT, or we can call the weighted average cost of capital. WACC is the overall required return for a firm. This is because directors will often use WACC internally in order to make decisions and determine the economic feasibility. WACC is the discount rate that should be used for cash flow with a risk, and it's based on cost of debt, cost of equity, preference share, and cost of common stock. And this is the formula of WACC. WACC is the sigma WE multiplied RE with a WE is the proportion of time E capital in total funding, and RE is cost of capital times E. So I will go to the meaning. The meaning of WACC is to use 100 Vietnam đồng of business capital in a year, how much the enterprise will have to spend. And WACC is also used at a discount rate to calculate the present value of the cash flow in the assessment and select investment project of enterprise from the point of view. And this is the example. So because WACC is very important, so I hope you guys can help me to calculate the WACC of the example. So I will wait a few minutes for the question, and then I will go to the answer of this. Okay, I will go to my answer. Before this, I will explain the question. Borrow money from a bank with an interest rate of 10%, so that the cost of debt is 10%. Refer stock dividend is 2,888 Vietnam đồng per share and per year, so that and the rise up refer share is 30 Vietnam đồng. So as you can see that the refer share is equal to 2,880 divided by 30,000, and we will have 9.6% a year. And common stock is the equity capital is 23,300 Vietnam đồng per share, and current dividend is 1,750, and the growth rate is 8%. So the RE, we will use the formula of the reverse part and calculate the RE is equal 11.42%. So the WACC, as I told you that WACC is the combine of cost of debt, cost of equity, retained earning, and reverse share. And the formula of WACC is the sigma of WE multiply RE, so that 45% of the cost of debt. You can see that the corporate income tax rate is 20%. ABC target capital structure is 45% in debt. So W of the debt is 45% plus 10% is the borrow money, and we will multiply 1 minus tax rate. Tax rate is 20% plus 2% is the refer share of stock, and multiply 9.6% as you can see on the slide, and finally is the cost of equity is 53%. 50% common stock, we will multiply 11 and 42%, and we will have 10 and 565% a year. So this is the theory of my part. Next, I will show you the Excel slide. The Excel. Before this, I will send you my Excel. So I hope that you can do it with me, because the Excel is I based on the real data of the one company. So I hope you can download it and do it with me. And I will based on the real data of the Southwest Airlines from today to calculate WACC. So now I can start it. Can you see the Yahoo Finance the current stock price? Okay, I will get started. Before we start, I want to tell you that the risk-free rate and expected market return is my number. It is not the real data because I cannot find the number of these two parts. So if you can find it, just tell me and I will replace it. So thank you. Firstly, this is the current price of the day, and as you can see that is 49.47. I will click share right is 40. Share outstanding is click to the financial. Share outstanding is 591.64 million, and I told you that our number is in thousand, so that if the share outstanding is 591.64 million, so we will price it because the unit is in thousand, so we just need write 551,640. So the market value of equity is we have to use share price multiply share outstanding. We will have the market value of equity right now, and the beta is 1.2. And as you and I will remind you the cost of equity is that R is based on scam RE equal risk-free rate plus beta multiply expected return minus risk-free rate. So we have the cost of equity is 8.65%. Nextly about the
assume that we don't have the beta of this company. How can we calculate the beta?
We use the coefficient. Wait a minute. I have right. The beta is will be equal the covariance of RE and RM minus variance. Teacher. The formula of beta is covariance divided by variance of expected rate return.
What is the alternative way to calculate the beta? To estimate the beta? If we don't use your formula, the covariance divided by the variance of the market return. If we don't use that formula.
About that, I don't have a result of this. So
in the book, the author show us the way to calculate or estimate the beta. The author can use the regression, and the model is the market model. The market model. That is the return of the stock return equal to the market return plus the beta. So you just use the simple regression, very easy to estimate the slope coefficient, and you can use the slope function in Excel to estimate the beta. Okay.
Yes, I will check it later. So can I continue, teacher?
Of course.
Next is about the depth. Because we don't have the end of the 20 and 21, so I will use the long-term depth of 20 and 20 and long-term depth of 20 and 19 to calculate the WACC. It is 20 and 20, and the second column is 19, and the long-term depth of 20 and 20 is equal plus all the current borrowing and 19 we will do the similar. Plus all the current borrowing 119. So the average debt is $6,498,000 in interest pack of 20 and 20. We just go to the income statement. Interest is spent on $340,000. And the interest cost, we will use the interest pack divided the average debt. Income before tax. Next name. Currency.
What are you looking for?
I looking the interest before tax and income tax expense.
The interest expense.
Yes. Wait a minute. I
Interest expense.
I
So you know net interest income.
Yeah.
What is net interest income?
Net interest is the net interest.
Technically, the company borrow money from bondholder or the bank, and the company have to pay the interest. So that's the interest expense. Somehow the company invest in many kinds of bond, or they can lend the money to the other company which is need the money to operate. So they have the interest income, and net interest incomes equal to interest income minus the interest expense.
Yeah.
So the net interest income is a negative number, which means the interest expense is much more the interest income.
Yes. Wait.
So in this case, you need to use the interest, the net interest income. This is the interest expenses when we minus the interest income.
Yeah. The pre-tax income is up 2020 a minus 4,256,000, and income tax expense a tax provision a 1 million minus 1,182,000. So the tax rate will be the income tax expense divide income before tax will be 28%, and the way of that is equal will equal D divide E plus D, and the equity is E. So because we have the old number, so we just calculate the weight of debt and the weight of equity. The weight of equity is market value of equity divide the long-term debt, and the weight of debt is so if you want to know that it is right or not, you just click weight of debt plus weight of equity. If the result is 100%, it means that you are correct. And so that because we have the enough data, so now we can calculate the WACC. WACC is equal weight of debt minus interest cost. Is 7 and 30%. So in the Excel, can anyone don't understand? So if you don't have any question, I will end up my presentation here, and the next part is the cham present. Thank you.
Hello everyone. Can you see my screen?
Hi, I can see. Yeah.
Yes. I'm from Group 1 and I will present the last part of our presentation. Part 4, valuation based on the consolidated statement of cash flow. And in this part, we examine the firm's consolidated statement of cash flow and use it as a basis for estimating the future free cash flow. In part 2, you discuss the definition of the free cash flow, so I only recall it. The free cash flow is defined as the cash produced by a business without taking into account the way the business is financed. Is the best measure of the cash produced by a business. And here are some formulas you may need. This is the enterprise value, and this is free cash flow, and this is the weighted average cost of capital, and this is the long-term real rate. And now we will move on to a simple example on Excel. Here, and this is the consolidated statement of cash flow for the past 5 years. And this is the given information. And firstly, we will calculate the net cash provided by operating activities by using some function. And we do the same with the remaining years. Secondly, we calculate the net cash used in investing activities. Also by the Also by the sum function. Thirdly, we calculate the net cash used in financing activity. Finally, we calculate the changes in cash balance. This amount plus this amount plus this amount. And in order to turn this consolidated statement of cash flow into free cash flow, firstly we keep on items under operating activities. We keep it, and in the section of investing activities, we delete items that are not related to operations. For example, this short-term investment net. And we completely ignore the financing activities. I will adjust some items to calculate the free cash flow. First is free cash flow. Firstly, we calculate the free cash flow before interest adjustment. This amount plus this amount, and do the same. And then we calculate the and back after tax net interest. 1 minus income tax rate multiply interest. And finally, we calculate the free cash flow. Yes. Here we can calculate this. And next, we will go to the next sheet to calculate the future cash flow. Also, interline value. This is the given information, and we calculated the free cash flow in 20 detail already. Yeah. Now we calculate the future free cash flow. Multiply 1 plus the rate of free cash flow. And do the same. And we fix it. Next, I will calculate the terminal value. This amount multiply 1 plus long-term real rate divided by WACC minus long-term real rate. Okay. And the total. Now, this is the important part. We calculate the steroid value by using NDV function. The rate is the WACC. The value is from to this and multiply 1 plus this rate to a power of 0.5. And we calculate the equity value, this amount plus this amount minus this amount. And finally, we calculate per share by this amount divided by 1 million. So we're done. And here's how to turn consolidated statement of cash flow into free cash flow. And we calculate the free cash flow and enterprise value. This is the end of my part and also the end of our presentation today. Thanks for your listening.
Oh, sorry here. Why you don't use the data table to have the scenario analysis for every long-term role and every WSC? So in this model, the Gordon model, the two factors are very important, extremely important, which is the WACC and the long-term growth rate. So if we want to do scenario analysis here, we can have many inputs such as the long-term growth rate and the WACC. And in every input, we want to calculate the value operation and estimate value. How we can do that?
Sorry, wait a minute.
Okay.
Sorry, I read about it, but I don't understand clearly. So can you please help me?
So I will explain you more carefully. In this situation, we using the Gordon model to discount the FCF with the discount rate at the FWACT. So when we discount the FCF into the present, we will calculate the enterprise value of the company. And if we want to do more analysis, the scenario analysis, and the two inputs we want to change are the long-term growth rate and the WACT. And maybe we can it to many numbers like 3%, 6%, 10% for the long-term growth rate, and this is similar to the WACT. How can you do that with the data table? Okay, let me help you in this case. We share my screen.
Oh, thank you.
Okay, as you can see here, we have the merged cash flow valuation models here, and we calculate the FCF free cash flow of the merged companies. We got the 1, 2, 3, 4, and 5 years, next 5 years. And you know, in this situation, we call the valuation based on the consolidated statement of cash flow, because the data we got here, the cash flow we got here, it's just the 1 year and the history data. And now we need the growth rate for the short term, the year 1 to 5, and the long-term growth rate for perpetuity. It's a forever. So you see, this growth rate used for calculate the free cash flow from year 1 to year 5. And after the year 5, we use the long-term rate to calculate the FCF to forever.
Sorry, I can see your slide.
Okay, sorry. Okay. Do you see my screen?
Yes.
Okay. I will say it again. When we use the Gordon models, in this situation, we need to have two growth rate, the short-term growth rate and the long-term growth rate. The short-term growth rate here from the year 1 to 5 to apply to the cash flow from the year 1 to year 5. You say we have the cash flow today from the history data, and we estimate the cash flow for the first year to the 5th years using the short-term rate. the short-term roll rate. And after that, from the 5 years to forever, we use the long-term roll rate. Okay, and we use the Gordon model here to discount it on the cash flow to forever with the long-term roll rate 3%. We discount on the cash flow in the perpetuity to the 5 years using the Gordon model. This is a Gordon model. Yes, this is a Gordon model. And the terminal value of the 5 years is here. The $464,423,000. So we keep discount in the second time, and now we discount the cash flow from the year 1 to year 3 plus the terminal value, yes, plus the terminal value here. So when we discount on up this money, we have an enterprise value. Yes, and from the enterprise value, we can calculate the stock price. It's quite easy here. I don't need to explain more. But now we have a more analysis like this. We call this is the scenario analysis. Scenario analysis is the analysis which you can change the input, and the output will appear and will automatically calculate in here. And as I just say, we can use the data table technique to complete this task. Okay, so let I show you how to do this. First of all, you need to show us what the long-term roll rate you will to input your model, and what is the WACC you will input your model. Okay, and then you say we will replace this long-term roll rate into this cell, every this long-term roll rate into this cell, and every WACC into this cell, and if we replace on up the number into the two factors into the both cells, they automatically calculate the enterprise value here or the actual stock price here. So we can use the data table. The first one, we will need to enter the target cell here. The target cell will be appear in every cell in our table, but we will use the target cell here. In this situation, we need to use if function to make sure the long-term rate in the Gordon model, the long-term roll rate will be less than the WACC. And as you see in the Gordon model, we have the cash flow divided by the WACC minus the long-term roll rate, and the condition is the long-term roll rate will be less than the WACC, or WACC will be greater than the long-term roll rate. Okay, and that's why we use the if here. And to put the actual stop price here, and to put the actual stop right here. This is a actual stop price is the stop price from the market. This is the stop price will be calculated from our model, the share value from our model, the stock value of our model. This is B17 here. we put here. We would be 17 here, but we use the if function to make sure the long-term row rate will be less than the WCC. Just simple. So we choose on the block of the data table. We use the data and what if analysis. So we call the data table here. And the raw input cell. So we can see here is a raw input cell is a long-term raw rate. You indicate the long-term raw rate here. So the data table automatically replace every long-term raw rate here into this cell and calculate the share value from our model. And it's equivalent to the column input cell. You want to replace on of WACC here into this cell, and this will calculate the stock value from our model. Yeah. Okay, so you just okay, and this give us the result. There's something wrong here. I think we it's because the long-term row rate isn't. So we can see the long-term row rate is the negative number, which means in the far future, somehow the company decrease the cash flow, not the grow in the cash flow. We can change a little bit here to reach the positive number. Okay, so I start with 1%. So we can see if the long-term row rate greater than the WCC, the Gordon model is invalid. So we need to use if here. If we don't need to do that, and we just keep the WCC greater than the long-term row rate, and we just use 2, 3, 4, 5. Okay, and this is and in this intersection, the first cell intersection in the data table, we just put the output. Sorry. We just put the output share value from our stock here. We don't use the if condition here. So we choose on of this table, and we use a what if analysis data table, and in the row here we indicate the row rate, long-term row rate cell. Okay, and in the WCC we indicate WCC here. Okay, so you know how the data table work, and in every situation, for example like this, we have two input, which is in which the long-term row rate is 3% and the WAC is 6%, and at that situation our stock value is $119.43. Okay, this is a simple. It's a very simple. With we can do it the scenario analysis. I I just told you in the first session of this course, the scenario analysis. When we change the very critical input and we calculate the output of our models, we use this scenario analysis, and data table help us to do that. Okay. Okay. So let's wrap up some information about this session. I have to say, a little bit disappointed with some of presentation, especially the WACC calculation, because you guys don't follow our learning material. So it's a very major differences between our course with the financial corporate finance course or the other course you just have learned, because in this course we focus on the reality, we focus on the practical situation. So we deal with the numbers, and some of numbers maybe generate the problem or generate the drawback, the disadvantages. So we need to follow on the knowledge in our textbook, and we use the situation, we use the practice in our textbook to make sure we understand on our knowledge, and to make sure we have a skill, to make sure we have skill to deal with this problem in the reality. Hence, I recommend you to read the book carefully. Yes, read the book carefully. And if you don't understand anything, or if somehow you cannot catch the idea of the author, cannot use the practical situation to explain how we can solve the situation, you can just ask me. You can email and you call me for your question, and I will explain to you. Don't use the old knowledge. Don't use the old material learning from all the course, from the old course you just learn, you just study, because it's different. I repeat it. This is the major difference between this course and other course. This course is a very practical. It's very practical. And other course maybe provide you the background theory, yes, the framework to know the problem, to know the concept. But in this course, we practice, we calculate, and we estimate the problem. We solve the situation. Remember that. So stick with the material I give to you. Remember, stick with our textbook. Okay. To evaluate the corporation, we have 4 approaches. Using the accounting book value to calculate the enterprise value, or using the market value to calculate the enterprise value. This is the second way to estimate the enterprise valuation. The third way, we use the consolidated cash flow. And make sure you understand what is the consolidated cash flow. The consolidated cash flow is the history data that a company provide in the financial report, in the financial statement, and audit company check it. Audit company check it. and this is a consolidated cash flow. And you just have the history data, or just have the cash flow of this year at the moment. Of course, we don't have the cash flow in the future. And if we want to estimate the cash flow from the future, we must have the growth rate for the short term, and we would have a growth rate for the long term to forever. And we use the Gordon model to discount all of cash flow back to the present. And the third and the fourth approach is to use the pro forma balance sheet, the pro forma financial statement, which we will discuss on the next session. So using the pro forma financial statement, what is a pro forma financial statement? Pro forma financial statement is the forecasted financial statement, and all the items you forecast for the next year, the next 2 years, the next 3 years, and the next 5 years. And you use on the balance sheet or income statement, the forecasted balance sheet, the forecasted income statement to calculate the future cash flow. You don't use the short-term growth rate here to estimate the cash flow from the year 1 to year 5, but you use the forecasted balance sheet, forecasted income statement to calculate the cash flow from the year 1 to year 5. But in the perpetuity, in forever, we must use the long-term growth rate, and this is a very important. This is our assumption. It's our assumption. And you say the critical question is: the long-term growth rate is it appropriate, or is it relevant to the company, or is it too much? Is it a positive number? Sometimes it's a negative number. Does the company in the future will decrease their cash flow, not increase their cash flow? So it's the big question here. Hence, we must have a scenario analysis in which we provide many possibilities for long-term growth rate and to calculate our share value here. Okay. And WACC is chapter 3. As I can say, you let me a little bit disappointed because you guys follow the own knowledge from the own course, and I encourage all of you in this class to read chapter 3 again in the book. It's not difficult. I have to say it's not difficult, because all of this learning we already study in all the subject. But now in this subject, in this course, we use the framework, we use the theoretical background to practice, to imply our knowledge in the reality. So read chapter 3 again. You guys need to read chapter 3 again, because if some of you want to make the final project about the enterprise valuation or about the WACC calculation, you need to carefully scrutinize, carefully examine our content in the chapter 3. Okay, in the chapter 3. Okay, I think it's enough for today, and I think so I will give you a mark for your presentation. Despite of a little bit disappointing, but I will give you the 8.8 mark for your presentation, and I hope all the groups in next session will follow my instruction. And if you have any obstacle or any difficulty, just let me know, and we will discuss outside the class, and we will discuss outside the class, and it will give you some clue, some hint. Make sure you understand everything in this chapter and you present it to the rest of class. Okay?
Thanks, teacher.
Okay. Okay, goodbye everyone. Hope to see you in the next class. Thank you.